It's a great pleasure to be here. I've spent a lot of time in Manila over the years. Obviously, now in my new role, I intend to spend a lot more time here. It's a pleasure to be here. Thank you very much for the invitation. When I first spoke to Richard, he said to me, "Can you cover the whole entire Asia Pacific real estate market in 25 minutes?" I said no, but I'll do my best. And what I thought to approach this was the best way to look at the market is what's happening in the world. There's a lot of global risk out there, and what is the impact on real estate in Asia Pacific? And I'll try and draw that into Manila. And I will also tell you one day the story as to why I was born in Pakistan. It's a very long story. So I think if you look at 2016, it really was a year of unexpected outcomes. There was a lot of turbulence in the marketplace, and yet in this part of the world in Asia Pacific, real estate markets were relatively robust. And sort of in a nutshell, we think 2017 will be a similar outlook. We've seen essentially global growth accelerating, arguably led by the US. This part of the world, here in the Philippines as well, very vibrant, young, dynamic, consumer-driven economies that are fueling this growth. And Asia Pacific really is, in the world, looked as the future of the global growth hub. There are headwinds out there and there are tailwinds. Obviously, we have a new president in the United States. We've kind of got a lot of fallout still going on with Brexit, and we've got China still on the global stage, still a big player, and a lot of impact from China on this part of the world in Asia Pacific. And from a real estate perspective, Asia Pacific has caught the spotlight of investors. Last year, it became quite challenging to find assets to buy, to develop, and what we saw is investors diversifying their risk and looking to alternative asset classes. In our world, things like data centers, aged care, healthcare, education as alternative source of high returning, less risk real estate, which is a trend we'll see continuing into 2017. Demand on the whole in APAC is strong. You see that here in the Philippines, 50% of the market is BPOs. It continues to drive the office markets across the region. There is a huge amount of Asian capital uninvested, $32 billion of dry powder, meaning money that's allocated to real estate in this part of the world that is not yet put to play. And that's significant sums of money. As I said, this is the growth engine in this part of the world, obviously led by India, China, and the Philippines. Total growth in the region this year looking around about 5%. It probably would have been higher if China growth hadn't been coming off the high sixes to the low sixes. This is very key. Again, similar, all three economies have got this young, consumer-driven economy driving this growth. Great to see that Asia Pacific overtook the US and Europe in 2010, and you can see the gap between these markets is widening. Already Asia Pacific is already twice the size of Europe. In this part of the world, we've got the number 2, 3, and 5 global economies. And so I don't really like this chart because my global CEO looks at this chart and he goes, "What's wrong with you? Where's the double-digit growth?" And I'm sure many of you in this room face the same problems. This is kind of a risk matrix. The way we look at this is the greens are the positive. Obviously, potential here, the US can drive the world out of the slow growth that we've witnessed. If that happens, it have a massive impact. On the right-hand side, this is a much talked about phenomenon. What's going to happen with China? And I had the pleasure of working in China for 17 years and living in China for 10 years. And we've talked about this for a long time. Obviously, the potential impact on fallout in this part of the world is significant, but we just don't see it at the moment. Brexit, I think this is the one to watch. A lot going on in Europe still. If one more of those European economies goes through a referendum and pulls out, this will be very, very turbulent times. Asia Pacific kind of weathered the storm last year with the UK exiting. If there's another exit in Europe, this will hit the global economy, and it will certainly hit Asia Pacific, given China is a big trading partner with Europe. So it's down to the US. Can the US drive us out of this kind of low growth outside of Asia Pacific? I mean, US confidence liked what Trump was saying in the run-up to the election. US confidence, retail confidence is up highest for 15 years. You've got unemployment rates at below 5%. So the market in the US liked what the future president was saying. We've got lower energy prices. We had an OPEC meeting in October last year. Oil prices are going up, which is fueling growth again and liquidity in the Middle East. We've got higher interest rates. You saw the first base 25 bips raised last week. It's quite likely they're going to see another 3 rise in interest rates. I mean, it could be a negative, but on the whole, we see that as helping Europe stimulate growth and obviously help China, in a way, rebalance its own economy. And currency movements in our world in real estate, from investor standpoint, this is critical when you look at markets. What is the impact on the economy? It is highly likely that the US is going to continue its appreciation. The US dollar is going to continue its appreciation. I mean, here he is, Mr. Trump. He hasn't quite done, President Trump, I should say, hasn't quite done his first 100 days, but he said a lot of what he's going to do. And he's got some pretty sensationalist policies out there. Sorry, my clicker's not working. Here we go. I think probably the most outlandish of his policies, we all know well, is his stance on immigration, his stance on tariffs, particularly against China and Mexico, and now more noise about taking on some of the healthcare reforms. On the whole, we've seen in this part of the world, we've been relatively immune to those kind of nationalistic, protectionist noise, but Europe has jumped on the bandwagon, and you can see a lot of the hard right governments or potential governments in Europe like what he says around immigration, because it's a tough issue in Europe, and the European nation is very divided on immigration. Brexit, as I said, this is really where I think the turmoil is in Europe. Obviously, you've got elections in France and Germany coming up. We've just had the result in the Netherlands. President Rutte won. The extreme right, Wilders, he was the guy of, we're going to go to referendum, we're going to exit Europe, we're going to hit hard on immigration. So in many ways, the sort of assessment I have is that if there was another country that goes out of Europe, and if it had been Holland, it would have started the dominoes falling, which is the dominoes here. The sense now is, I think a lot of the other nations will see what happened with Holland, they'll see the impact on the UK, and sense will prevail. And obviously you've got the French election with Marine Le Pen, threatening a referendum. You've got the Danish, the Nordic states threatening a referendum, and now Scotland are back on the bandwagon. And anyone who's Scottish, one person in the room I know well, I don't know, maybe Scotland's going to go independent. But this is the one I worry about. And there's a lot going on in this year. There's a lot. The Dutch thing's over. I think that's a good outcome for Europe. Essentially now we've got the French entering a very, very important presidential rally debate. If they exit, if there was a referendum, I think that is going to be very, very tough for Europe, as I said. The Germans are coming in, probably a little bit more stability in Germany, but a lot of tension in Germany around immigration. And then finally, and very importantly, China. And this coming up to the 19th Communist Party National Congress towards the end of the year, November. And I think, talking of China, this is critical to this part of the world. We have had a reliance, particularly here in the Philippines, on what happens in the US and US FDI, but I think China's becoming an increasingly important player in the world of politics and in our world of real estate, because this region is becoming quite reliant on China. China's slowing its growth. Why? China is very focused on the money that it's driven through investment into its economy to shift to more consumer-based economy, a more service-driven economy, in the same way that the Philippines is becoming a service-driven economy. It allows them to free up investment into their big one road, one belt policy, which, if you like, is their way of going global. And the Chinese are creating these, if you like, landline trading corridors and maritime trading hubs, pushing out huge investment. And they're saying over the time that this will take, it will create 11 million jobs globally. This is a significant investment. And this is very important to this part of the world. And Trump's first big play was to exit TPP. It was very alarmist in Asia Pacific at the time. It hurt the potential for real estate investment. And we've kind of come through that in a 2-month period. There's a sense of confidence back in the market that actually China is critical trading partner to this part of the world. Currency, as I mentioned, in my world of real estate, this is very, very important. If you look at the euro and the sterling are not on this chart, but the sterling is at a 30-year low with the dollar, and euro is at its lowest ever since 1999, since its inception. In fact, a dollar, a sterling, and a euro are kind of all the same these days, so it's kind of easy to calculate. But you'll see here, towards the end of the sort of yen and the Australian dollar, there was a very big sharp rise in those currencies. The reason being, when the euro and the sterling were down, a lot of investors shied away from Europe, shied away from the UK, and pumped money into this part of the world in real estate. And you saw that big push up in the Australian dollar and the yen as a result of that. So what I'm saying is currency and real estate have a very important linkage, which is also important to this part of the world, because investors all look at real estate in terms of total returns in real estate, but you have to adjust it for FX if you're playing outside of your markets. So you can see Manila, in terms of FX adjusted returns, in this part of the world in Asia Pacific, Manila is one of the most attractive markets to invest in. And I think that's important going forward when this market needs to get more international in terms of investment from outside directly into real estate, not just FDI. So it's exciting times for Manila. So a lot going on. What does this all mean? Obviously, President Duterte went up to China, I think it was in October last year, and they've started working on some trade agreements. This was very, very important. I think the importance of the Philippines and China becoming healthy trading partners is essential. It's essential in my world of real estate, because we see a huge amount of Chinese capital wanting to get into real estate in all of Asia Pacific. Obviously, a little bit of geopolitical concerns out there. The peso, I believe, is at a 10-year low, which also has some issues, but it means that the market is still competitive on a global scale for those looking for foreign direct investment. Manila still is a great play with the peso. Trump's making a lot of noise about America first and the people first, and we're bringing jobs back to America. And so there's been a little bit of noise around the impact on that on BPO and real estate in the Philippines. I think put simply is, the Philippines and other markets like India, from a BPO standpoint, have been very, very focused on growing their infrastructure, growing their talent. And those kind of low attrition rates, attractive labor costs, and now an attractive real estate cost makes this market very difficult to beat. It's not easy to go and replicate what the Philippines has done. 1.3 billion people employed in BPO, $25 billion of revenue. You can't replicate that overnight. So Trump's talking big. What we're seeing with a lot of our clients, both here and India, from a Philippine standpoint, it's business as usual for all the people that are here. People remain confident. We have a small BPOs here. We have 4 small centers here. We only employ 90 staff, but we're committed to growing it in this part of the world. There's a little bit of noise about new entrants because of some uncertainty. We think that's short-lived. It's very important for the Philippines, and we'll think the momentum will pick up. Here's a slide that kind of summarizes Asia-Pacific real estate in totality. It's kind of steady as she goes in this part of the world. I think, to be honest, to put one slide with all of the markets is relatively meaningless, because markets trade in different directions. But generally speaking, in this part of the world and in the Philippines, leasing is stable. There's still good, healthy demand. Investment is up, more likely 1 or 2%. Capital value is up 1 or 2%. Rents are rising 2 or 3 or 4% in this region. What we're seeing is we've had this big cycle of real estate growth, so inevitably at the end of a real estate cycle you see a huge boom in new constructions to feed that strong demand that's out there. And here in the Philippines you've got 30% year-on-year growth in terms of new supply. So Asia-Pac, steady as she goes, the Philippines, steady as she goes. This is putting all of the markets on a clock. 1 to 3 o'clock is rental values are essentially falling. 3 to 6 o'clock, rental values are bottoming out, and then through the rest of the clock, you're seeing rising rents. Now, obviously, this is just an illustration. dots don't move all at the same time. Some dots move quicker, and some dots can even go backwards on the clock. But it's a good snapshot in time. This is global. You can see pretty much all of the markets are on the rise. There's a few on the fall, but let's bring it to Asia Pacific. So it's interesting you're looking at Asia Pacific. Again, the majority of the markets in terms of office rents are beginning to rise, continuing the growth story, continuing on the back of consumerism, continuing on the back of demand, and relatively slow environments in terms of oversupply. Interestingly, there's a couple of standout markets, Sydney and Melbourne. Why are Sydney and Melbourne performing so well, and yet the Australian economy is only growing at 1 to 2%? The reason being is the country has gone through a big shift away from mining reliance, a reliance on mining, and a reliance on China consuming everything out of the ground in Australia. That's slowed down, and they've shifted towards consumerism, they've shifted towards the tertiary, the service sector, and they've got this huge growth. So actually those two markets, Sydney and Melbourne, are growing extremely quickly and the fastest in the region. You can see a lot of the China markets slowing down. This is demand is coming off in China. This is China having gone from this investment-led economy and a big push into the service sector. The service sector is slightly slowing, and there's a lot of supply in those markets. So naturally, some of the rents coming off. And good old Manila, you know, it's at the 10 o'clock position, very healthy growth. We can see continued growth in the office sector here in Manila. Demand. This is always a difficult one to measure. We look at some of the net demand growth across the region. Interesting to see emerging Asia driving the top of the demand cycle. This is very good. It's good to see the Philippines growing. Metro Manila, 600,000 square meters of net absorption. That is very impressive. And then you've got Tier 1, Australia and Melbourne, that service sector shift, and then some of the Asian gateways. Interestingly, when you look at the markets that are relatively in decline in this part of the world, the Tier 1 markets of China, Shanghai, Beijing, Guangzhou, demand is coming off. They've had a massive boom in terms of growth, and now we're starting to see it come off, and it's impacting their position on the clock. Also looking at India, relative competition to Manila in the BPO world, Bangalore and Mumbai also starting to come off from those very, very high aggressive peaks. Looking at employment, of course, employment creates the need for office space. And in 2015, there was 21 million net new jobs created in Asia Pacific. That's a significant number. India, according to Oxford here, will grow 80 million jobs in the next decade. A phenomenal 80 million jobs, which would probably represent in excess of 60% of the total net job growth. Interestingly here, you've got Perth, we're looking at 2015, was coming off the back of a mining boom. That job creation is going to disappear, which is pushing Manila up to the top of the markets of job creation, which is very, very important and a good indication of strong demand. Limited supply, I mean, these bubbles represent the relative supply of total office space in the market. And I'm not sure if you can read the chart on the right, but Manila, over the next 3 years, Metro Manila is creating 3 million square feet of new office space to support that demand. And what we're seeing in Manila is broadly office supply and demand is broadly in check, which is why rents continue to grow in this important city. This is putting rents in context with other cities. Obviously, you've got Hong Kong up there, the most expensive office market in the world. Hong Kong, despite oversupply, is holding rents. Why? Because the Chinese are continuing to push into Hong Kong in a big way like they've never seen before. 70% of all investment into Hong Kong last year was Chinese investors. And 40% of all demand into Hong Kong was Chinese investors. So China is going global, and obviously they're pushing very hard through their kind of sister city, if you like, Hong Kong. As I mentioned, Singapore and Melbourne growing at 12% for the reasons I explained. Shanghai, has been a big outlier. Where I lived for 10 years, we used to see 20, 30% rental growth, 40% in some years. It's coming off. Why? There is a massive supply coming in the decentralized markets. It's holding Shanghai back. Manila, it's not a bad place to be at the bottom of this chart. For once, being at the bottom of the chart is not a bad place. It's good for Manila. You do not want to be up at those prices of Hong Kong. You will not be competitive. So for the property developers in the room, I'm sorry that rents aren't growing aggressively. 4% is not bad. And for the occupiers of space, it's a good story to be in Manila. And I think this is a story that will continue in the years to come. Interestingly, when you compare on a log scale where the markets are relative to the peaks of the pre-global financial crisis, pretty much most of the markets have kind of got above their peaks. Hong Kong not, Singapore not, and Tokyo not. It's interesting, those are relatively mature institutional markets that haven't got back up there. But some of the emerging markets like Beijing, Manila, and Shanghai have pushed up on the back of strong service sector growth, as I'd mentioned, and low supply in those markets. Sorry. Capital values. Capital values have performed very differently to rents. This is not normal, and it's interesting. If you look at all of the markets on the same log scale of the rents, they're pretty much, in terms of the value of the real estate, the value of the office, are way above the pre-global financial crisis. Why? What we've seen is huge confidence in Asia Pacific as a region from an investment standpoint, which means what we would define as yields, returns on real estate, have compressed significantly in this part of the region. That is purely driven by investor confidence, both local investors and foreign investors believing the future of real estate, believing the future, betting on the future of office rents rising over the years to come, pushing returns down on real estate. And if you look at the red bar, this is kind of the 10-year yield range which we've seen in all of these markets. Every single country is at the bottom of the yield range, meaning there's huge pressure on those yields. Capital value is rising, rent's not rising quick enough, yields are coming down. And guess what? Manila is right up there as a market which provides one of the most attractive yields for investors, both, of course, locally and foreign. But foreigners put in the FX, and I showed you already that the FX still puts Manila right up there. So this is good for Manila. Nearly there. You probably can't read this slide, but if it's green, these are all the different markets across the region. If it's green, it means it's a tenant-friendly environment. If it's red, it means landlords have got the upper hand. If it's orange, it means it's neutral. And Philippines, over the next 4 years, we see what we call a neutral market, mean neither the landlord, neither tenant has a real upper hand, which generally is a good place to be because deals get done a lot quicker. They're easier to do. It's a win-win for the tenant and the landlord, and that's a good market to be in. So if I summarize my last slide, and I hope I'm on 30 minutes, we continue to see this increasing allocations into real estate into Asia Pacific. This is important for the region, it's important for the Philippines. Money is pouring into this part of the world because it's seen as the global growth hub of the world. We will see a lot of kind of risk mitigation and divesting into other types of real estate, which if you work for JLL, this is exciting because this is what you see in mature markets, not necessarily in APAC. Here in the Philippines, I mean, still relatively restrained bank lending, and as I've showed you, minimal oversupply. We're not seeing the market in oversupply. So we see that balance, that's that orange. There's no trouble on the horizon here in the real estate markets. The strength of the dollar, I mean, this is going to continue. You've got to bet. You've seen the 25 bips increase in base lending. It's probably going to be, as I mentioned, another 3 in the next 18 months. You're going to see a lot of currencies continue to depreciate against the dollar. On the whole, in this part of the world, this is important. It keeps you competitive. I think that's obviously very significant, particularly here in the Philippines. It's all about service sector growth. Young, dynamic, consumer-driven economies are going to continue to grow. And again, that's important. That fuels all real estate. All the net operating income in the world from real estate, and most of the real estate rental rises are all single digit. It means markets are in check, healthy balance. nothing running out of control. And as I said, the outsourcing and offshoring is going to continue to drive in this part of the world, particularly into the Philippines. As I said, JLL, we remain very confident in our own ability to grow our own business here and grow our offshoring here as well. We believe in the country, we believe in the quality of the people, we believe in it remaining competitive from an FX point of view. So we have a very positive outlook on Manila and the Philippines. So now, that's my last slide, I think 30 minutes, and we're going to have some panel members to ask all the difficult questions about the Manila market, which I may not have the answer to. But thank you very much for listening.